let me tell you about the Consumer Price Index and why it's so important for traders to keep an eye on this economic indicator. First of all, the Consumer Price Index, or CPI for short, is the average price level of goods and services purchased by consumers in a given country. Shortly, I'll go over the explanation in a lot more detail, but what this means is that it gives us a really good idea of how expensive things are for the average person and whether or not prices are rising or falling. Now, you may be thinking, why should I care about this as a trader? And well, let me tell you, the CPI can have a huge impact on the financial markets, causing huge shifts in price movement. And if you're not paying attention to it, you could be missing out on opportunities to make money, and you could even potentially lose money if you're being ignorant. You see, when the CPI numbers come out, they often have a huge impact on the value of currencies, stocks, and other assets. And if the CPI is higher than expected, meaning that prices are rising faster than anticipated, then traders might start buying up assets in anticipation of inflation, driving up their prices. But if CPI is lower than expected, meaning that prices are rising more slowly than anticipated, then traders might start selling off assets, causing prices to drop, and in addition to affecting asset prices, CPI can also have an impact on interest rates. If inflation is high, then central banks might raise interest rates in an attempt to control it. This can have a huge impact on the value of currencies, as interest rates can make a currency more attractive to investors. So, as a trader, you need to be aware of when the CPI report is coming out and be ready to attack and react to it. Now, that's not all. The CPI also gives us other valuable insights like the overall health of the economy. If prices are rising too quickly, then it can be a sign that the demand for services and goods is outpacing supply, which can lead to shortages and other economic problems down the road. On the other hand, if prices are rising too slowly, it can be a sign that there is not enough demand for goods and services, which can lead to slower economic growth. Now, let's go into a little bit more detail on how exactly CPI is calculated. So, how is it calculated? Well, it starts off with a huge basket of goods and services that are a representation of what the average consumer buys on a regular basis. This basket is going to include things like food, it's going to include things like clothing, healthcare, transportation, and more. Once the basket of goods and services has been selected, the next step is to collect data. So what they do is they survey a sample of stores and service providers and other sellers to get an idea of what people are actually paying for these items. And once the data on prices has been collected, it's weighted based on how much people actually spend on each item. For example, the housing market is going to, cost more than your average budget for clothing. So the housing is going to be weighted a lot heavier on the overall CPI. It's going to change a lot more based on the housing prices than it would be off of the clothing prices. Now, once the data has been collected and weighted, the next step is to calculate the actual CPI number. This is done by dividing the total cost of the basket of goods and services by the same basket in a base period. The base period is typically set to 100, so any number above 100 indicates that prices have risen since the base period, while other number below 100 indicates that prices have fallen. It is worth noting that CPI is calculated on a monthly basis, so the data is constantly being updated to reflect the changes in previous prices over time. So this is important because it allows policymakers and investors to stay up to date on the latest economic trends and make informed decisions about things like interest rates and asset prices. In short, the Consumer Price Index is a really important economic indicator for traders to pay attention to. It can have a huge impact on asset prices, interest rates, and it can also give us insights to the overall health of the economy. So if you're not paying attention to CPI, you're potentially missing out on some huge opportunities to make money and stay ahead of the game. The CPI is one of the many tools in your arsenal as a trader, and by keeping an eye on it, you can stay one step ahead of your competition and maximize your profits. If you're looking for strategies to possibly increase your results on news releases and getting funded with $100,000 or more from prop firms to maximize those results, click the link below to apply for the Funded Profits Trading Academy, where we teach you and mentor you on your way to becoming a funded trader. If you enjoyed this video, leave a like and don't forget to subscribe for more content like this, and I'll see you on the next one.